So let's now look at a couple of questions that was asked in ACCA's past exam question paper. This was asked as part of September 2022 examination. So the first one is Forsythia group. It's a very good question because it is very much targeted to quality management and professional matters during an audit. Such questions are something that you can expect, and the approach towards such questions should be assessed based on the risk for the audit. Why? Because if we are seeing certain quality issues done by the audit managers or audit partners, then that could affect the audit risk, in a way. So when we approach this question, they have given us two parts. One is a brief introduction and the requirement. Second is an exhibit relating to the Forsythia group. Now, whenever you see an exhibit like this, it is expected that you are required to comment on the exhibits. You have to take examples from the exhibit and mention what is wrong with the exhibit and what should be the approach, what should they be doing. So what, why and how is what I'm gonna approach this particular answer based on. Like, what is the issue or what is the quality management issue? Why it is an issue? Like, what is the impact if that issue is persists? Second, what should be the approach? How that issue will resolve, or how that issue could be counterfeited, or how that issue could be subsidized, is the how part. So what, why and how is something that we need to look at. So let's read this answer. I'm not going to write everything, but rather I'm just going to give you pointers which will help you to frame your answer. I want you to write the answer by yourself and compare it against your the answers that is given in the textbook using my inputs, which will help you to prepare yourself. At the same time, give you a starter of how you can start writing this particular answer. Forsythia Group, it is 1st July 2005. You are an audit manager in Magnolia and Company, and you are currently conducting an engagement quality review on the audit of Forsythia Group, the group, which is a listed entity. Your firm is appointed to the audit consolidated financial statements and the individual financial statements of all group companies. The following exhibit available on the left hand side of the screen provides the information relevant to the question. Forsythia Group, summary of comments made by the audit team regarding the performance of the audit. The information should be used to answer the question requirement within the response provided. Evaluate the quality management and other professional matters identified during your review in respect of the planning and performance of the Forsythia Group and recommend appropriate actions to be taken. Professional marks will be awarded for the demonstration of analysis and evaluation, professional skepticism and judgment, and commercial acumen in your answer. Exhibit: Forsythia Group. The audit of Forsythia Group for the year ended 31st March X5 is in the completion stage, and the auditor's report is due to be issued next week. The group has diverse operations focusing on manufacturing, but is also involved with activities in some other areas, such as agriculture. The draft consolidated financial statements include revenue of 129 million, profit before tax of 18.6 million, and total assets of 465 million. As you can see, it has increased. Even the revenue has increased, but the profits have declined, and the assets have also increased marginally by $5 million. You have discussed the group audit with a junior member of the team who made the following comments about how it was planned and carried out. On 10th June X5, the group acquired another subsidiary, Robin Company, which is forecast to increase the group revenue by around 20%. This means that group chief financial officer had little time to discuss the matters with the audit team. So definitely the chief finance officer not giving enough time to discuss the matters relating to the finances to the audit team raises a concern of quality within the financial statements. If they do not have time to resolve the matters, many matters will be unresolved and many matters might not be rectified, which could lead that there could be certain misstatements in the financial statements. The acquisition had taken place quickly and so did not form part of the audit planning, which took place in January 2000 X5. So the audit planning was done in January X5, which means after the planning was done, the acquisition happened, which means it's a subsequent event, isn't it? We are planning an audit for the 31st March 2000 X5, and the planning happened in January 2000 X5. The audit engagement partner said that we did not perform the audit work on any aspect of the acquisition, as according to CFO, it will be accounted in the next year's financial statements. So the acquisition happened on 10th June 2005. So this is something that we need to highlight. Okay, this is something that we need to highlight. So our acquisition happened on 10th June 2005. Planning happened on January 2005. Year end is 31st March X5. Now we know that this is a subsequent event. Why? Because any event that occurs after the year end of the financial statements is a subsequent event. But it could be an adjusting and non-adjusting event. Definitely acquisition happened on 10th June X5. So it is a non-adjusting subsequent event. But the books are not yet closed. And the company acquired a company called as Robin Company, which is gonna increase the total group revenue by 20%. So it's gonna increase total group revenue by 20%. We would have learned in group audits, significant component. If a component is contributing to 20%, it could be a significant component. Which means that even though they acquired the subsidiary only after the year end, and since the subsidiary is going to contribute around 20% of the group's revenue, it could be a significant component entity. Due to which it has to be disclosed in the financial statements. It's not required to be adjusted, because as at the year end or before the year end, it was not acquired. It was acquired after the year end. On 10th June X5 only it was acquired. But disclosure is required. So the CFO commenting that it will be accounted for the next year's financial statement is incorrect. Second, the audit engagement partners stating that no work need to be performed is also incorrect. And this could also indicate that audit partner does not know about or does not have enough competence or lack of knowledge, due to which he is not doing a major amount of work with respect to the Robbie company. As per the standard of quality management, it is very much vital. As well as as per the planning of ISA 300, it is very much vital that if a significant change has happened to the entity, the planning have to be revised or the planning have to be updated. And certain audit procedures should have been performed on Robin Company, and appropriate disclosures should have been made in the financial statements. If the group CFO is not planning to make any disclosures with respect to the acquisition, it could show firstly the deliberate intention to omit the information, which would indicate an integrity. Further, a potential misstatement in the financial statement with respect to lack of disclosures. Either ways, this is a significant risk for the company. It's a significant risk for the company. And if the necessary disclosures are not being made, then audit opinion should be modified. It will impact the audit opinion and it should be discussed with the group audit committee, and relevant audit procedures should be made and determine the extent of disclosures that should be required with respect to this entity. Okay. So that's what we can gather from this particular paragraph. From this paragraph, that's what we can gather. Right? And further, when we read the other paragraph, we will get some more points with respect to this. Due to pressure to reduce the cost, the audit manager arranged the audit procedures on revenue recognized by several material subsidiaries, including a subsidiary in the agriculture industry, to be delegated to Camellia Associates, an unconnected firm. The audit manager said that we can rely on the evidence obtained by Camellia Associates, as they are a firm of qualified accountants. So, budget constraint is a big issue. Now, due to this budget constraint, as per ISA 220, if there are budget constraint, it could lead to question of exercising professional judgment and professional skepticism. Due to budget issues, the client would be pressurizing the auditors to finish off the work as early as possible, due to which appropriate professional skepticism might not be applied by the partner, and he will thereby start to agree with the CFO and failing to challenge him the assertions. And that is also evident, the budget constraint is also evident in this paragraph, where the audit partner is agreeing to the CFO that nothing has to be disclosed, but instead of challenging him. Due to the budget constraint, due to this particular aspect, he's agreeing to this, which results in not exercising appropriate professional skepticism by the partner. And that has reduced the audit quality. And the audit partner, as per the audit, ISA audit quality, ISA 220, all quality management, it is Magnolia's team, the auditor's responsibility and accountability for a firm implementing a firm-wide audit quality. And the partner not doing that shows that the audit quality is primarily lower on the audit performed by this particular engagement partner of Forsythia group. Further, it also questions the audit quality being performed by other partners in the same Magnolia entities. Because if they are agreeing to this and working according to the budgets of the client, it indicates that they are not exercising additional professional skepticism to question the client and get things corrected in the financial statements. So audit planning should be revisited. Appropriate quality is not provided in this particular issue with respect to the acquisition of subsidiary, and that will be our first point. So now let's talk about this specific aspect, which is delegating the work to Camellia Associates. So as per the standard, or as per the necessary provisions of the ISA does not prohibit that an audit firm cannot delegate their work to some other audit firm. It's not problem. But the problem here is the attitude of Magnolia entities towards the work that has been delegated. As you know, within an audit firm, if a work is being assigned to a staff, the staff work is reviewed by the senior's work is reviewed by the manager, and the manager's work is reviewed by the relevant audit partner. That's how the review system works. Only then, as per the quality management, there will be the review process should be followed, which will ensure quality being exercised by the employees. However, in this situation, as you can see, the audit manager said that we can rely on the evidence obtained by the Camellia Associates as they are firm of qualified accountants. But even though they are firm of qualified accountants and we can rely on the evidence obtained by them, it is very vital and important that the work of audit work done by Camellia Associates should not be simply relied upon, but rather proper review and proper documentation should be followed by the engagement partner. The partner should ensure that Magnolia's team go through Camellia's documentation and see if appropriate documentation and evidence have been collected as according to the audit plan and procedures defined. Without the review, the audit partner cannot consider whether evidence have been obtained and appropriate audit have been performed with respect to the audit plan, or sufficient appropriate audit have been performed according to the audit plan, and appropriate opinion cannot be given without going through the review or reviewing the documentation of the Camellia Associates files. Further, the area that was delegated is of a concern. The area that was given by Magnolia company to Camellia Associates is revenue. Revenue is a highly significant risky area, and as per ISA 240, auditor's responsibilities relating to fraud, it requires the auditor to work on the presumptions that there is a risk of fraud in revenue recognition. So hence, revenue recognition is considered to be a high risk audit area. And considering it is a group, giving material subsidiaries revenues to Camellia Associates is a bit questionable action. And also the revenue has increased significantly compared to the last year. So there is a bit of high risk involved. And the question of whether Camellia have enough knowledge, do they have enough resources, do they have the competence on reviewing such a large group's revenue recognition itself is a question. Specifically, revenue recognition in relation to an agricultural industry. Do they have the enough knowledge? Do they have the experience and expertise to do that is a questionable action. Just because they are qualified firms does not give an evidence stating that they have enough knowledge and competence. Also, they are a firm of qualified accountants doesn't mean they are registered firm. We need to check whether they are a registered firm of auditors and whether they have enough experience as well as expertise of performing group audits in and specializing in agriculture sectors or not. If they do not have any experience doing an audit of agricultural firms, then it is questionable to delegate the work to Camellia Associates. So the conclusion in this particular point is the work done by Camellia Associates should be fully reviewed, and whether sufficient and appropriate audit evidence have been obtained or not should be checked as per the audit plan. And also, Magnolia Associates should perform certain analytical reviews in relation to the revenue to see if the risk can be reduced and Camellia Associates work is insufficient or not should be checked, so that appropriate necessary steps could be taken with respect to the same. Now the third aspect or the third point is in relation to the development cost being capitalized. Now development cost that is being capitalized around $1.2 million. So when you compare to the profit before tax, $1.2 million is around divided by 18 is around into 100 is around 6.6%, which is considered to be material amount. Now I would put it as this is a significant amount. Why? Because with an intention that the profit before tax compared to the last year have actually declined. So from 23 million to 18.6 it has declined. And as you know, if a development cost has been incorrectly capitalized, the development cost have to be written off. If it is incorrectly capitalized, the amount should be written off into P&L as an expense. So if it is treated as an expense, then the profits will further reduce by 1.2 million. By around 5% it will reduce. So here the question is, here the question of the matter is whether appropriate standard of intangible asset capitalization have been followed and whether the auditor have taken sufficient appropriate evidences to corroborate that the capitalization of development cost is appropriate with respect to the IAS standard of intangible assets. But that is not the case that has happened. If you can see, it's mentioned very clearly. That I have audited the group. I also audited the group of intangible assets. Who audited it? The junior. The junior member of the group audited the intangible assets, and he has not discussed with the CFO with respect to the assumptions that was taken, but rather he just agreed the assumptions with respect to the technical feasibility and commercial viability to the group's business plan and concluded that they were consistent. This is the first year of development cost that have been recognized in intangible assets. So which means the first year in which the development cost has been capitalized. So it was not capitalized before. It's the first time they are capitalizing 1.2 million. That is questionable. It further increases the risk. What if there are certain research costs that should have been expensed off? And Further, the assumptions relating to technical feasibility, commercial viability is not the only aspect that has to be checked against the development cost that can be capitalized. Development cost follows a criteria of pay rate, probable intention. All of those criteria should be reviewed by the auditor before they capitalize the development cost as per the IAS 38 standard. And that has not been done here. It is an important and a significant part of the audit, and it has been done by a junior, showcases the lack of quality being of performance of audit quality, not performing the audit quality according to the appropriate level is being established by the company or by the firm, audit firm. As ISQM 1, International Standards of Quality Management 1, clearly states that individuals who are assigned to perform the activities or relevant accounts should have appropriate competence as well as capabilities, sufficient time, and their work should also be reviewed. Just by assigning the junior the audit of development expenditure is not appropriate. It should have been dealt by a senior member of the team, and further review process should be done so that the senior member could have discussed the matter with CFO and further evidences could have been obtained before concluding the appropriateness of this accounting treatment. So appropriate quality with respect to the audit of development cost was not exercised by the firm. These are the problems that we have identified with respect to the development cost that was capitalized. And the last and final one is you company. You which operates in an industry in a subsidiary of a group. At the planning stage, the line of the previous audit, it was not considered likely to increase the aggregation risk. However, due to the specialist nature of the operations of the company, a consultant should have been used to provide input of some technical matters. As stated in the audit strategy and audit plan, due to cost implication, the consultant was not engaged. Following your conversation with the audit session, you reviewed the working papers. The audit obtained by Camellia Associates have not been reviewed by the audit manager or partner. So that shows to the quality over here. Second, no further evidence have been obtained relating to the development expenditure. That is also a problem. You has a total assets of 60.5 million and a revenue of 6.5 million. So what is the percentage? So you represents 60 million of assets divided by total assets of 465 million. So 60.5 divided by 465 is around 13%. From the revenue side, 6.5 million divided by 129 million is around 5%. Is around 5%. Right? So what does it mean? It means that there is an aggregation risk. There is an aggregation risk for this particular company because it represents 13% of the group assets and 5% of the group revenue. 5% of the group revenue. In the previous year, if you compare the previous year, 6.4 divided by 113 was 5.6%. Whereas 83 million divided by 465 is around 460 is around 18%. 18%. So which means that there is a risk involved. Why? Because from 18% it has reduced the assets by 5%, which means from 83 million of assets, you company's assets have reduced by 60 million. Why? That is unusual and that is a significant risk. Why did the assets reduce? What is happening to this company? That would add to the aggregation risk. An aggregation risk is the probability that aggregate of uncorrected and undetected misstatements exceeds the materiality of the financial statements as a whole. Which means if you company has certain misstatements, it will aggregate to the group entities misstatements on the financial statements as a whole. Now we can see from here that you contributes to the aggregation risk because you represents 5% of the group's profit. Which means if there are misstatements in use revenue, it could contribute to the aggregation risk in the group's financial statement. And just by saying that it is not contributing shows that the audit partner is not competent enough. The audit partner is not competent enough, and it is not appropriately, documented, and appropriate planning is not done. Further, it's mentioned clearly that due to budget constraint, consultant could not have been appointed. So ISA 220 requires that the audit partner to take responsibility for consultation on difficult and continuous matters. And deciding not to follow the strategy for the same reason due to cost saving is not appropriate. They cannot say, oh, you know what, we don't have enough cost, due to which we cannot hire a consultant. That's not appropriate. Due to a lack of input and insight from the consultant, it could lead to specific audit risk where appropriate and appropriate evidence would not have been obtained, which could contribute to the individual financial statements of your company as well as the group financial statement. And also ISA 300, as per the audit planning standard, ISA 300 requires that any changes to the audit strategy should be mentioned and fully documented. But this plan was changed, but it was deleted from the audit files. You cannot delete it. You have to keep that particular audit plan and mention it further documentation that the audit plan will not be followed with respect to the consultation, and just by deleting it is a bad quality that have been performed, inappropriate quality that have been performed. You cannot delete data from the audit files and where it was signed off by the partner during the stage of planning. If the consultant was not being hired and were not being done, in that situation it should be appropriately documented why there was changes. This shows the integrity of the company, of the auditors, that they are deleting certain aspects in the audit working paper, and questions could be raised that further material files could have also been deleted from the audit planning stages, just because of the fact that there were some cost cutting measures that was concluded. So these are the issues, and this is how we approach them. So what we'll do is, again, we will try to write it in a format. I'm not going to write the entire answer over here, but rather I'm just going to write it into pointers, and that pointers I'm just going to remind you so that this is the way you can write it, and you can look into those pointers and try to complete the sentences, which will help you to create a beautiful answer and compare that answer against the answer that is given in the textbook. So first and foremost, for these kind of questions, it's very vital and important that you start with a introduction. So which means you need to mention to the examiner that what entity that you are trying to answer and for which particular entity, etc. So always give a heading that Forsythia group, which is evaluation of audit quality. All of these adds to the professional marks. So you can say that as the Forsythia group is a listed entity, it is appropriate that an engagement quality review, which is called as EQR, is taking place, right? And this is accordance with the ISQM 1, which requires an EQR to be performed on the audit of the listed entities. So that's number one that we are trying to do here. Okay, that's number one we are trying to do here. Okay, now the first point that we are going to write in relation to this is acquisition of Robinco. So we have acquired Robinco. So we are going to talk about the answers in relation to the acquisition of Robinco. So you can write about the ISA 560, which is subsequent events, which is what we discussed. So you need to mention a brief about this particular standard, that the acquisition. So you can mainly point out saying that the acquisition, okay, the acquisition of a subsidiary after the year end should not be ignored by the audit team, right? Should not be ignored by the audit team. And as per, you can say the next point, that as per ISA 560, okay, it needs to be considered whether the event may need to be recognized as an adjusting event or disclosed in the group financial statements. So that needs to be considered. As per the ISA 560, it's very clearly mentioned and guidelines is given that if there is a subsequent event that has happened, then the subsequent event should be considered whether they have to be adjusted or it should be it should be adjusted, or whether it should be disclosed in the group financial statement. And further, in this case, the acquisition is after year end. So it's after year end. So it's a non-adjusting event, and no adjustment is required, but disclosure should be made, right? So this is the what of the statement, like what went wrong. This is what went wrong, right? This is what is went wrong. Now we are also going to say that the audit partner is therefore incorrect to agree with CFO that matter will only be considered in the next year financial statements. That's wrong. That's wrong. So this is what the issue is. Now why it is an issue? Why do we think this is an issue? What is the impact? Now if you look at the impact, firstly, the subsidiaries revenue is to increase the group revenue by 20%. So which means it appears the acquisition is material to the financial statements. Therefore, appropriate audit procedures should be performed to determine and conclude the relevant disclosures that are necessary. Now why do we, okay, acquisition of subsidiaries is good for the company, right? But why do we need to disclose it? See, how do we know that it is good for the company? As an auditor, we are not bothered about that. Whether it is good for the company or whether it is bad for the company, whether it will help the shareholders, whether it doesn't help the shareholders, we are not bothered about that. What we are bothered about is, as per the standard, if there is a material acquisition that has happened, it has to be disclosed. Because the shareholders will have to know that what the company and the management are doing with the shareholders' money. The shareholders' money is given, the shareholders' money is taken to fund the acquisition. What if the acquisition does not end up being a fruitful one? The shareholders will question the auditor. You did not tell me. Right? You did not ask the entity to disclose it. What if the shareholders, few of the shareholders is not agreement with the acquisition and they don't want to continue with them. They want to sell off their shares. So it's very vital that when such material material transactions happen, it has to be appropriately disclosed in the financial statement. It has to be disclosed in the financial statement. So the audit partner agreeing to this also further highlights the fact that the audit partner's statement could indicate his lack of knowledge or could be due to the cost constraints of the audit team, right, of the audit team, which leads to issue of professional skepticism not being followed by the partner. Right? Why? Because as per ISA 220, budget constraints are one of the key parameters to exercise of professional skepticism on an engagement. So due to the cost pressure, the audit partner is failing to apply appropriate level of professional skepticism. So due to the cost pressure, the partner is not applying appropriate level of professional skepticism by agreeing to the CFO instead of challenging the assertion. So instead of challenging the CFO and mentioning the fact that, okay, you know what, this is not how it should be done, the partner is agreeing to him. It shows that lack of professional skepticism being applied by the auditor. Further, then we talked about the leadership team, okay, of Magnolia and Co is responsible and accountable for firm-wide audit quality, and as a partner who is not following quality standards suggests that there is a potential firm-wide quality risk. So indication that, okay, the partner himself is not following the appropriate quality or not exercising appropriate professional skepticism. It shows that there are further wider issues and which are not being followed here could lead to a risk. And then we talked about audit planning, right? So we said that as per ISA 300, the auditor shall update and change the overall strategy of audit during the course of the audit when information comes to the attention of the auditor that significantly changes compared to initial information. However, given the speed of acquisition of Robin, it is understandable that the acquisition was not known at the planning stage. So considering they were acquired quite faster, the auditor would not have been aware of that, okay, the company is acquiring a acquiring such company, so they don't know. Okay, that's fine. But the audit partner should have reacted to the acquisition, and so but the partner should have reacted to the information and revised the audit plan, and appropriate procedures should have been amended or added to the plan to determine the matters to be considered to disclose in the financial statements with respect to the acquisition. So audit partner, what he should have done, the moment he came to know about the situation, he should have amended the audit plan saying that okay, there has been an acquisition and appropriate procedures and plans have to be implemented, stating that, oh, you know what, this particular acquisition have been made and these are the appropriate documents that we are going to review, and whether the review of the documents, whether it should go towards the disclosure of the financial statements or not, should be considered. Right? That should be considered. Further, integrity of the CFO. Group CFO, okay, so the group CFO is planning not to disclose the information in current year financial statement could indicate lack of competence, okay, that he doesn't know whether it should be disclosed or not, or deliberate intention to omit information in the financial statements, right? So this increases the audit risk. It increases the audit risk, and further audit procedures are required in this regard and also to the other areas of financial statements. So in this regard, further in other areas of financial statement, specific procedures should be done. Example, in subsequent events. So subsequent events is being now a question mark because there is a risk involved. The CFO saying that he don't want to disclose, it's clear that he doesn't know the standard. So which means what there could be, other subsequent events which he is deliberately ignoring, or he doesn't know whether it should be disclosed or not, which could be an adjusting event as well. So in respect to the subsequent events, review of board of directors minutes, meeting minutes, or legal advisors correspondence should be done to determine if any adjusting or other non-adjusting subsequent events have been ignored by the CFO, right? By the CFO. And then for the conclusion, if necessary documents indicate that disclosures are not made in the group financial statements, a material misstatement would exist, and it should impact the audit opinion. So that will impact the audit opinion, because if the group CFO is further saying that no, we are not going to include the disclosures with respect to this, then it could impact the audit opinion. So the next one is in relation to the delegation of audit work. So delegation of audit work to Camellia Associates. right? So that's what they have been delegated. So it should be very clear that it's not prohibited. So it's not prohibited to delegate audit work by the audit firm to other audit firms. However, the evidence should not be accepted without proper review. Without proper review, you cannot simply go and accept the audit evidence. It has to be reviewed. It should go through the appropriate review channels, right? So as per ISA 220, as per the ISA 220 standard, it's very clear that engagement partner shall determine through review of the audit documentation and discussion with engagement team that whether sufficient appropriate audit evidence has been obtained to support the conclusions reached and for the auditor's report to be issued. So without the review, the partner cannot consider whether the evidence is accordance to the audit plan or whether they are sufficient and appropriate to support the audit opinion. So that's number one. Further, the work that was delegated, so delegating the audit of revenue is particularly problematic given that the group revenue has significantly increased by 14% during the year, right? So the question raised whether Camellia has performed the audit work and whether so the question is whether Camellia have performed the work with whether they have performed the work with appropriate quality, whether they have appropriate knowledge and understanding of the group or not. That's the question that we need to ask. Also, do they have enough resources to perform the audit with quality? And further, do they have enough competence in agriculture sector to perform the audit of the agriculture entity? That's a question that we need to ask, right? That's a question we need to ask. Just because they are a firm of accountants doesn't mean that they are a registered audit firm. So that also should be considered. Is Camellia Associates a registered audit firm? Doesn't mean that they are doesn't mean that they have enough competence expertise in this area or expertise handling, necessary experience handling group audits, that too activities in agriculture sectors or not. So that should have been considered. So the competence, okay, competence, qualifications, knowledge, experience should have been undertaken, should have been reviewed by Magnolia before assigning the audit work. Further, as per ISA 240, revenue, there is a presumption that there are risk of frauds in revenue recognition. So it's a high risk audit area. So the delegation of the revenue was not appropriate. And finally, as a conclusion, Camellia Associates work should be fully reviewed and further audit procedures such as analytical procedures should be conducted by the audit team in order to understand whether the work have been done by the Camellia Associates with appropriate quality or not. So the next one is development expenditure. The issues that we have noted in development expenditure, that's what the next one that we are gonna explain about. So what was the issue with respect to the development expenditure? See, firstly, we need to mention that the accounting treatment, okay, treatment of development expenditure capitalized is significant as this could lead to misapplication of IAS 38 intangible assets standards. Okay. Further, we need to check whether the development expenditure is actually material. So development expenditure capitalized is a material transaction, and further the profits has decreased nearly by 20% compared to prior year, indicating risk that entity could have manipulated this expenditure by capitalizing it to increase profits. Could be one of the aspect. Then further, this is the first year. So since this is the first year of development expenditure being capitalized, it will further increase the audit risk. It is further increasing the audit risk, right? And we can conclude that insufficient audit evidence have been obtained relating to the development expenditure being capitalized. Okay. Confirming that a set of management assumption agrees to the assumptions from other source doesn't provide a validity of the assumption themselves. So just agreeing the assumptions and confirming it doesn't provide the evidence of the validity of the assumption themselves. Right? Further audit procedures are required to conclude the appropriateness of the accounting treatment applied. Like whether all the criteria of IAS 38 have been fulfilled or not. Right? Further, ISQM requires, right? One requires that individuals assigned to perform audit activities should have appropriate competence and capabilities and sufficient time as well. In this situation, giving this to an audit junior is not appropriate. It should have been dealt with more senior member of the team. These are the issues that we have identified in development expenditure, right? So they can just go and confirm it, the assumptions that they have agreed the assumptions. No, all the criteria should have been reviewed. Further, all the criteria with respect to the IAS 38 standards should be reviewed. Okay, IAS 38 standards should have been reviewed instead of just looking at the assumptions and saying that, oh, you know what, we confirm the assumptions. No, right? That's not appropriately done. The last one with respect to this is U company, right? So the audit here the issue is that the audit partner suggested that U company does not increase aggregation risk. Okay. So the next, as a next sentence, what you need to write is, what is aggregation risk? So what is aggregation risk? So you need to explain the definition of an aggregation risk. So you can write aggregation risk is a probability that aggregate of uncorrected or undetected misstatements exceeds the materiality of the misstatements of the group as a whole. So you can say that it is the probability of uncorrected and undetected misstatements exceeds the materiality for the financial statements for the group as a whole. And you can give the results that based on draft financial statements, U has 13% of group assets, 5% of group revenue in current year, and 18% of group assets. Okay, 18% of group assets and 5.7% of group revenue in prior year. Further, okay, the reduction in value of its assets of use assets is unusual and significant. So this further decline of the value of the group assets is really not appropriate. It's not appropriate, right? Further, the operations of you in agricultural industry, okay, right, which is different from main operations of the group. So hence it creates what? Significant risk of material misstatement and requires special audit consideration because it's a special item. Firstly, it is a it's unusual and significant, and the group assets is considered, so U is deemed to be a significant component. You can say it's a considered to be a significant component, right? So in this situation, special audit consideration should be created. So which could lead that U is more likely to increase the aggregation risk. Increase the aggregation risk. So the audit quality risk raised is that you have not been identified as an aggregation risk at the planning stage, either in this year or in the prior year, and have not been adhered to. Is an it could be an example for a lack of appropriate materiality level being used or lack of appropriate planning or quality being used, right? So you can say that you company not identified to be an increasing aggregation risk at planning stage of current year or prior year, have some quality issues, I could say that is an indicator of quality issues and not adhering to the appropriate ISAs, etc. Right? And it is very consideration that it is not used in in prior year, even when based on the monetary values as an asset is made material to the group. So it is concerning that U was not considered as increasing aggregation risk in prior year due to monetary values as its assets are material to the group. Assets are material to the group, right? So therefore, what is the rationale behind this? So the rationale behind this needs to be investigated, and additional audit work will need to be performed, right, on you, including engagement of consultant to provide advice on special aspects of use operations, right? And this is very clear that as per ISA 220, audit partner should take responsibility of consultation on matters, difficult matters, and saving of cost is not appropriate. So due to this, a lack of input from consultant, okay, the lack of input from a consultant indicates there are specific audit risk to you for both individual and group financial statement as a whole, right? And also ISA 300 says that, as per ISA 300 says that changes to the audit plan have to be documented in detail, including the reasons for the changes. But it appears that this has not happened. Sections of the audit strategy and audit plan should not be deleted even if there are valid reasons to change them. So right, so therefore an integrity issue can be should be raised, given that the working papers have been deleted in an attempt to conceal deleted with respect to the consultant expertise, and in an attempt to conceal the fact that audit plan procedures have not been performed. So instead of performing the audit plan procedures of hiring a consultant and doing it, what did they do? They just simply changed the plan and just deleted that they will hire a consultant, etc. But instead of doing that, what did they do? They just changed the plan, but they didn't document the change. And as per ISA 300, it's very clear that if there has been any changes to the audit plan, it has to be documented with reasons of why there is a change. You cannot go and just simply delete the words from the audit plan procedure and say that nothing has happened. No, that's not correct. And finally, you should mention a conclusion statement or a conclusion paragraph citing the reasons of what are the audit quality and summary, that where have they been done, etc. And all these will have procedures will have to be additional procedures will have to be performed, and the deadline should be extended. The client's deadline should also be considered to be extended. Extend the deadline to make changes to the audit plan and procedures. So that the auditor can perform these kind of procedures, and checking the Camellia Group's documentations, doing further procedures of development cost, including disclosures in all of those things, to ensure that it is adhered to the ISA 220 as well as the IASQM1 requirements. The remedies have to be changed and further procedures have to be performed, and hence the client should be requested to change the deadline.